Today, we'll be discussing the different types of investment risk. Hello, welcome to Money Talks. My name is Ken Wink from Summit Financial Consulting. If you'd like more info about what you hear during our show today, give us a call at 586-226-2100 or visit us online at our website, summitfc.net. While you're at the website, be sure to check out the podcast page. You can check out the old episodes, and you can also subscribe on Apple Podcasts, Spotify, or Amazon Music. So this year has been a little bit of a hectic one. We've had some inflation that maybe was a little bit higher than expected. We've had tariff wars. We've had interest rates that didn't drop maybe as fast as everyone was hoping. Pretty volatile stock markets, some global uncertainty. I would argue there's never been a better time to just look at your entire portfolio and just see where it stands from a risk standpoint. So today we're going to be discussing the different kinds of a risk, explaining them a little bit and just see what we can do to maybe help improve your long-term chances of success. But before we dive in, let me bring in my co-host, Tony. Tony, I've been told that you are testing your own risk tolerance by drinking gas station coffee instead of your regular Starbucks. Is this true?
You know what, Ken? It's not true. I'm having an iced coffee right now from not a gas station. I try to typically avoid a gas station coffee, but I would drink coffee from a drive-in, since you did mention drive-in in the opening instead of dive-in. But, my dad was an over-the-road truck driver, and so I'd ride along with him in the summers when I wasn't going to school.
Wow.
And, you hit every truck stop, and I got used to truck stop coffee. It builds character, right?
Yeah.
Like, it builds character and a strong stomach. So
Yeah.
I have a resistance built up, but I'm this topic you've got for us today, it's kind of a carryover, really. It's a continuation of our discussion from last week because, investment risk is a little bit of what we talked about, but we didn't really dive into the different types of risk. We talked about having your own personal risk tolerance and what you needed to do to stay diverse, but what are some of the risks that you want to discuss today?
Yeah, the first one is the biggest one that keeps us up at night for people that I guess don't have a proper financial plan. I'm such a worrier, Tony. I'm worrying about the people that aren't even our clients.
Sure.
But it's sequence of returns risk, and
Sure.
most people have never heard of it. So this is basically the risk that you retire at the wrong time. So just give me 30 seconds of math here, folks. Don't change that channel. Just hang in there. Let's just say you had $500,000 and you're taking 5% per year. Some people say you should take less than that, less than 5% per year. But let's just say you're taking 5% per year, and that is generating $25,000 per year of income. And then all of a sudden, boom, a financial crisis happens. And this really happened in 2007 to 2009. People lost half their money if they were invested too aggressively. So your 500,000 is now all of a sudden 250,000. So rather than taking out 5% per year, you're now taking out 10% per year because the value of your account shrunk so much. So this is sequence of returns risk. This is how you become Mr. Unlucky and you just retired at the wrong time. There's a really good chance you're going to have to go back to work or get a part-time job because the probability of that money getting back to where you want it to be is pretty slim when you take a hit like that and you're drawing a monthly income. So
Wow.
either cut your expenses, cut your income, or get a job, unless the market just fires back up really, really quickly. But, if you look at the chart of the S&P 500, it took almost 5 years for it to come back. So that was not a slingshot that people would need to not be crippled by sequence of returns risk. So this is why we feel so strongly that people should have a bucket plan. You want to set aside your first 5 to 10 years worth of income in something that's safe. Or at least safer, relatively speaking, so that if the market has a big drop, you're not being forced to basically sell low. I mean, that's sequence of returns risk in a nutshell, is you're forced to sell low because you retired at the wrong time and the stock market dropped on you.
Yeah. Well, a sequence of returns, you wonder, well, what does that mean? It's when you take money out when the market's down, right? And you have to constantly take money out to live on in retirement. So then you are at risk if you retire at the wrong time during a down year, during a down period, like you say. And it leads into what we talked about last week in managing risk, so you don't have that happen. Diversification can help solve that sequence of return risk, right?
Yeah, yeah. If you're overly concentrated in a one sector or one stock, that can definitely amplify and make sequence of returns risk even worse.
Right.
And people are asking, why are you guys talking about risk right now when the stock market's pretty much at all-time highs? It's had a good year overall. The last couple of years have been good, actually. Like things are going pretty well. Well, what goes up must come down. It might not be a bad time to take some profits and then set some of that money aside in something safe if you're depending upon your investments to live off, for retirement. If you've got a pension and Social Security coming in and you're not really needing to pull from your investments, then sequence of returns risk isn't really a big concern for you unless there's something that might pop up unexpected, a new vehicle, purchasing a investment property or a vacation property, or maybe a health change, and now you need to go into a long-term care facility, which can be pretty pricey. All of those things might just make sequence of returns risk show up at your front door
Sure.
unexpected.
Yeah. Yeah. Well, if you only have the market to pull from, so you have to pull out money to live on when it's down, that's why we get into go back and listen to last week's show to figure out how to you don't have to do that is by diversifying and working with someone like Ken and your team there. Now, that sequence of returns risk, what's the next one?
Liquidity risk. So
What's that?
unfortunately, in our industry, Tony, there are a lot of people who are not fiduciaries. So when you're a fiduciary, you have to do what's best for the client. When you are
Mm-hmm.
not a fiduciary, and here in Michigan, the majority of financial advisors are not fiduciaries, according to our research a couple of years ago. Um, Sometimes there are investments that pay very high commissions, and sometimes those investments are not very liquid, meaning you can't easily convert them to cash. So, private equity, real estate, especially real estate investment trusts, where, it's one thing if you buy a house on the corner because you can always sell it. But if you do a real estate investment trust, somebody else is in charge of when it's sold, and you might be stuck for decades.
Mm.
Collectibles. My wife actually had some old jewelry. I didn't get her. It was probably old boyfriends or, nobody important. Uh,
Oh, nobody important. I
Nobody.
don't know about that. Maybe
No,
maybe passed down from her mom or parents
she wasn't
or
actually sure. If Nana and Papa gave it to her, I apologize to Nana and Papa. But,
yeah.
anyways, the thing I wanted to point out is, like, there's the price of gold, and then there's the price of what you can actually sell the gold for, and you're normally
Right.
not getting it at the spot
Right.
price because
People, yeah,
they got to make a living too.
right.
So these are all examples of non-liquid investments because you can't get to them easily. If you can get to them, there's a cost. So we as a firm don't love hard to sell investments. There are certain financial
So my
products.
record collection, my vinyl collection,
Oh
you're
boy,
saying that's a
Tony.
bad
Yeah,
thing?
I
I've
don't
got a
know.
lot of money tied up in it. You're saying that's a bad thing, aren't you?
I wouldn't make that the cornerstone of your retirement plan. No.
Yeah. Yeah.
Yeah. So that's a big risk is whenever you're buying something that you're considering an investment, whether it's records, baseball cards, real estate, any type of,
Collectibles are usually tough because whoever you sell them to typically wants to sell them to make a profit.
right. Yeah.
You're not the end seller. You're selling them to a middle person. Especially if you're unloading a whole collection, there
Right.
usually aren't collectors out there willing to pay full collecting
Mm-mm.
price for an entire collection. You could sell
No.
them one at a time online, but that costs money and takes a lot of time. So
Right. So
yeah,
yeah, liquidity risk is a big thing to look out for. So anytime you're
yeah.
buying an investment, and sometimes I got to call it an investment, you
Put it in
gotta,
quotes,
yeah, you gotta make sure that
air quotes.
you could offload it if needed to at some point.
Yeah, yeah. I've tried to sell to my wife and kids that my record collection is an investment They don't buy it, Ken. They're not. They don't buy it for a hot second. That didn't work at all.
Yeah.
And I don't view it as that either. It's a passion. So, but it is. I have some records that I bought for $20 that are now worth $500 just for
Oh, wow.
just for one record. So, yeah, records can be valuable if you take care of them and they're in great shape.
The
Like
most
anything,
common thing that I see are people pass away and then their family are like, what are we going to do with these things? And they end up giving them
like
to
Goodwill,
somebody who
or
isn't
yeah,
final.
yeah. Yeah, exactly. Yeah, that's part of the problem. I mean, that's a gold mine when people find those, though, and they're worth money at a
Yes.
Goodwill. But good luck finding them at a Goodwill because people know now that they can sell them online for money. So usually they don't make it out. The good ones don't make it out to the floor.
Which one do you have that's worth $500? Holy cow.
Well, I have a couple. I have a couple. There's a lot. I have a sealed Beatles Meet the Beatles from 1960. It's not an original press, but it is a mono, and it's sealed. And I got it from my my second cousin, or my mom's cousin. Got it from him. He passed, and I got his vinyl collection, and it was mostly terrible, right?
Mm-hmm.
But he had a couple of gems in there, so that's one of them.
When you say
Um,
sealed, does that mean like he just never opened it and listened
Yep,
to it? Thing?
still in. Yep, still in the
Wow.
shrink. Yeah, those are usually worth quite a bit of money as long as they're not warped. Sometimes if you left them in the shrink, that shrink would warp them, and warped records aren't worth anything.
Wow.
And if they're too damaged, even the sleeve has damage or a sticker on it. Yeah, that's gonna devalue it. Anyway, we're getting off the topic here.
Yeah.
I always do that. You can't bring up music or records with me, or we'll be
Noted.
it's like a huge train derailment for the show. Credit risk. That's another one, right?
Yes, yeah. So anytime you own a bond, you have some risk. And it's tough because bonds have not done so hot the past 5 years or so. So there's a lot of people that are saying, you know what, I don't want to have anything to do with bonds. I'm just going to invest in stocks and sort of overload on stocks. So that's a separate risk. But
Yep.
credit risk, basically the whole idea behind credit risk, easily explained as, let's just say that you have an investment. We'll say it's a bond and it's paying 3%. And then all of a sudden rates drop to 1%. Everyone says, oh gosh, new bonds are only paying 1%. I want your bond that's paying 3%. So that's an example of an opportunity with owning a bond.
Right.
On the flip side, there is, let's say that you own a bond that's paying 3%, and then interest rates go up to 6%. Well, now nobody wants your crummy old bond that's paying 3% because I can get a brand new one that's paying 6. So that's one part of the risk of bonds. So we describe that as interest rate risk. But then what you just mentioned, credit risk, that is basically the risk that whoever you bought the bond from, they default. So when people buy a bond, a lot of times they don't realize that they're actually loaning someone money. You give someone $1,000 for a bond, they agree to pay you interest. And then after a certain period of time, whether that's 1 year, 5 years, 10 years, 30 years, they give you back that $1,000 that you loaned them. So you want to make sure that whoever you're dealing with, whether it's a corporation or a municipality, or even the U.S. government, that they've got a good financial strength rating. The ratings go from AAA, which is like the lowest risk, all the way down to junk status, which is in the Bs or worse. So you want to get as many A's as possible when it comes to your bonds, Tony, as far as avoiding credit risk is concerned. But, the United States government still has a pretty high rating, but I'm not so sure about loaning money to the U.S. government right now. The national debt's getting so out of control, and the interest rates that they're paying are getting worse because a lot of the debt was issued back in the early 2000s around COVID, when interest rates were in the close to zero, and now they're much higher than that. So there's just a lot of risk in the bond world. There's a lot of risk in the stock. So okay, I don't want bonds anymore. Like I said earlier, now you're over allocating to stocks. Stocks have their own risks. PE ratios are very high right now, meaning that the price that you're paying for how much earnings you're getting from those corporations is way above average. So that implies that maybe stocks are overvalued. So there's just a lot going on in the world today, Tony. You really got to
Well,
keep an eye on your risk.
Well, yeah, and Ken, when we talk about bonds, they used to be a great safe option. You used to use the rule of thumb: 60% at risk, 40% in bonds, and that was your safety. But your
Yeah.
principal isn't protected with bonds, so it's not true safety. And that kind of went out the window after COVID. Bonds tanked, and I mean, bonds have not been the true safety and haven't kept up with inflation, and like 2022 proved that the stock market was way down and bonds were way down. Used to be when the stock market went down, bonds were usually typically up.
Oppositely correlated. Yeah.
Yeah, oppositely correlated. And now they've been linked, and that's not good.
Right. Yeah.
Right.
It's a very risky environment right now.
Yeah.
Two more quick risks before we wrap up here. One is when you're looking at different investments and what they yield, don't just chase the yield blindly. So, you could invest in junk bonds, which pay way more than US government bonds. But guess what? They call them junk bonds for a reason. There
Yeah.
is some risk there. There is a chance that the company goes out of business and you actually lose your whole investment. So, you got to make
Mhm.
sure that you're doing proper due diligence and that your portfolio's sort of balanced to help mitigate that risk. There's also a ton of investments out there, Tony, where they will follow the price action of cryptocurrencies and high flying tech stocks,
Mhm.
and then they pay these dividends. Like there are investments out there right now that create call options and sell call options, and they're paying 40, 50, 60% annual dividend yield,
Yeah.
but then the price of the underlying shares is going down. So you're hoping
Yeah.
that the dividends are higher than how much it loses each year. It's just sort of it's a very, very risky situation. And I have
Right.
one client that's been following that strategy for the past 2 years. And at first he made a ton of money,
Yep.
but now some of these high flyers are just getting killed. And now,
Yeah.
he's
There are a
given
lot
up.
of those so-called digital portfolios out there. Some of them have been really good. There's a digital portfolio I know of that the first 2 years, I mean, the first year was like 100%. It was crazy, right? I mean, it was
Yep.
up a lot. And then the second year also really good. But then it had a down, then it started to go down again. So you can't put all your eggs in that basket either. I don't think there's anything wrong with having, tech stocks, obviously, or even a digital discovery portfolio where it is tied to things related to cryptocurrency, but not directly. You know what I mean?
Sure.
Because but I mean everybody's situation is different, and what they need for risk is different. What's the other risk you wanted to talk about?
Just horizon risk or like not the risk of not having an emergency fund. So just stuff can pop up. You can lose your job, you could get disabled, you could get into a car accident, your spouse could pass away. Um, there's ways that you can help mitigate that by having an emergency fund, by having insurance coverage, maybe having a side gig that you could turn into a part-time job or a full-time job,
Hmm.
but just unexpected events. You want to make sure that you're prepared and able to sort of defend yourself financially if something unexpected happens, so
Yes.
that you don't have to ruin your finances just to sort of survive. So
Right.
emergency
Like if
funds
you're
are
if you're
good.
yeah, if you're furloughed, right?
Yep.
Right now, a lot of federal employees haven't gotten a check in a month, haven't been paid in a month or over a month. How are you going to survive when that happens? A lot of most Americans don't have an emergency fund and live paycheck to paycheck. So that's really important, I think. And
Yeah,
we talk about that a lot, and we'll do whole shows on emergency funds. So that's
absolutely.
important. Yeah. Well, hey, Ken, a lot of great information here. I'm sure our listeners out there and viewers have questions. How can they get a hold of you to set up that no charge, no obligation consultation to get their questions answered?
We'd love to help. Give us a call at 586-226-2100, or you can visit our website, summitfc.net. We would love to put together a plan together for you to figure out exactly how well prepared you are for all of the risks that we discussed.
All right. Sounds great, Ken. And listeners, that does it for today's episode of Money Talks with Summit Financial and our host, Ken Wink.